What I think is interesting yesterday and today, like you said, with Micron, we're starting to see technology really take the reins again here. It's the best performing sector on a year-to-date basis. And I think part of that has to do with what the Fed said yesterday. They said, hey, the global growth is slowing down and it's going to be slower here. GDP will be slower here in the U.S. than we initially thought. And what you typically see is investors flock to areas where they can find growth, that they don't need the economy to drive them higher.
That's a great point. Steve, do you see that playing out? That,
Yes.
To start off January, a lot of people said, oh, well, we had the big sell-off, so you got to get defensive and so forth. No, it's been growth that's been working. Look at technology now.
Yeah, I think Lindsey's right on that. And, if the market if the market wants to go higher, the only way it can go higher is if it moves with those large cap tech names that got us here before. So I think everything has to participate, but you need tech. That's where people are reaching for growth. But for me, I would have thought that the market would have been a little bit spooked by his GDP forecast. I would have thought they would have been a little scared about that, and this is surprising for me to have the market do what it's doing today. I would also say,
yeah, go ahead, Steve.
the dollar and gold. To Rick's point, when you look at gold rallied yesterday. I understand that, sold off aggressively today. So I think there's a lot of head-scratching moves. I think a lot of this is just positioning right off of Powell.
Lindsey, does it feel like there's really a slowdown afoot? That's why I keep emphasizing the jobless claims and things like the Philly Fed reading. Understandably, the headline, the big GDP numbers are pretty bad, especially for the first quarter. But do people really think that either the Fed sees or that they see, a turn dramatically for the worse here?
I think the market's action, especially today, is telling you that market participants, investors, don't necessarily see that 2.1% is such a bad thing. That's still respectable growth in the grand scheme of things.
So the bar is just so low now that 2.1% is great news.
Yeah, exactly. And I think the way I look at it, it gives us reason to elongate this cycle too. That slow, steady growth is what kept this bull market going for over 10 years now.
So what would you tell investors to watch next? Earnings? I mean, now that we're kind of moving, we've got the Fed behind us now. I guess it all depends on if there's any sign of inflation or earnings, or what do you see?
Yeah, I mean, inflation, we got to keep an eye on that, but I don't think that's going anywhere fast. But I think the trade deal with China is a very, very important catalyst for this market. Now, Trump was talking about leaving tariffs in place for quite some time as an enforcement mechanism. We'll see if companies can't and the consumer can withstand that. So I think getting past that, that's a major uncertainty. And we'll see what companies say about that in Q1 earnings.
Absolutely.
Q1 is going to be very important.